Ladies and gentlemen, good day and welcome to the Q4 and FY21 earnings conference call of Mahindra Logistics Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shogun Jain from SGA. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and thank you for joining us on the Mahindra Logistics Limited Q4 FY21 earnings conference call. We have with us Mr. Ram Praveen Swaminathan, MD and CEO, and Mr. Yogesh Patel, CFO of the company. I hope everyone got an opportunity to go through our financial results and investor presentation uploaded on company's website and stock exchange. We will begin the call with opening remarks from the management, following which we will have the forum open for question and answer. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Ram, MD and CEO of Mahindra Logistics Limited, to give his opening remarks. Thank you, and over to you, sir.
Thank you, Sujit. Good evening, everyone. Let me begin by just sharing a message of hope. I trust all of you and your dear ones and colleagues are safe and keeping well. We are obviously in the midst of an unprecedented rise of the COVID pandemic across the nation. And it's critical that all of us take responsibility for our safety and the safety of those around us. And I hope all of you and your dear ones are doing well. I hope all of you had a chance to look at our results and the presentation which has been uploaded on the stock exchanges and the company's website. As always, I will begin my remarks by giving a quick update on the industry, how our end sector markets are working or operating, and our strategy. We will then provide some update on the operational and financial performance for Q4 FY21 and then open up for questions. The COVID-19 pandemic outbreak last year had a large impact on the country's economy as well as businesses across the spectrum. The logistics sector, with an estimated size of $215 billion annually, also suffered the brunt of these unprecedented circumstances. However, with the progression of the lockdown phases, people and businesses across the nation began adjusting to the new normal. And the economy started its path back towards recovery, with logistics being a key driving force in that process. Indicators such as rise in e-way bills, bill collections, increased rail freight connectivity, improving port volumes, etc., continue to suggest a strong uptick in logistics activity and a gradual recovery of the economy and industry broadly. FY21 was clearly a year of uncharted waters, and I speak on behalf of all the sector members when I say that we've tried to play our part in these challenging times. As you look at F22, I think it seems to be another year of uncertainty and volatility, especially in the wake of the sharp rise we have seen in positive cases right now and the spreading wave across urban and rural India. As you look at our end markets, we see several trends which are both opportunities and challenges in the short term. Let me begin with auto and then move on to the others. On the auto side, there are plenty of reasons for concern, but as well, there are many reasons for optimism as well. The industry was facing significant headwinds before the pandemic, and the impact of COVID-19 has only accelerated many of those concerns. Apart from the recuperating measures the industry will take to revive itself back, the times also demanded macro reforms at government level. The government has recently announced an outlay of 75,000 crores for the automobile and components, including batteries sectors under the newly announced PLI scheme. Given that automobiles account for a large part of India's manufacturing GDP, the scheme aims to accelerate domestic manufacturing, especially on the electric vehicle sector. Their PLI scheme could be a catalyst to boost the OEM exports and also help in the long term by strengthening the industry across the board. The scrappage policy will also have a significant impact over the medium term. Across the board, this will result in adoption of modern vehicles with better emissions, safety, and improved fuel efficiency. And the policy should give a much-needed boost to the industry, especially in terms of medium and heavy commercial vehicles. We continue to see strong improvement in the farm sector as well. I think the farm sector and rural India has largely has seen a lesser incidence of the COVID-19 impact. With the support of a strong and favorable monsoon and focused government policy support, the sector has done really well. It has shown continued momentum in the fourth quarter of last year, and we remain upbeat about its medium-term prospects despite the short-term challenges we have around the pandemic. The third sector which we are actively engaged in, of course, is e-commerce. E-commerce has clearly transformed the way business is largely done in many consumption-driven categories in India. In a country like India with over 25,000 PIN codes, the e-commerce industry, both marketplaces as well as others, have emerged as an important way of shopping, compelling many businesses working in the traditional brick and mortar model to make a shift. The e-commerce sector in India has shown exceptional growth and has evolved many folds over the last few years, and trend which has accelerated with the recent pandemic. And it is expected to continue its growth trajectory to become a market of over $200 billion by FY26. E-commerce continues to see really strong growth as all companies have been accelerating their focus towards digital channels. From Q2 onwards, we have seen rising demand and growth continue till the end of Q4 FY21. We expect that upward trend to continue and persist in the current fiscal. With strong customer partnerships, deep solutions capability and continued category expansion, we believe that we continue to add business wins and e-com will continue to show robust growth in the medium term for Mahindra Logistics. The consumer and pharma in space has been another important sector for us, covering a range of FMCG, durables, and pharma and related segments. In 2020, this segment turned the crisis into an opportunity, by really providing critical essentials in a very challenging period. With food and personal care items leading the demand for the segment, it has been clocking strong growth since Q2. And we're looking forward to carrying the same momentum while aligning to the future. On the pharma side, FY21 was an eye-opening year for every industry, and the pharma industry definitely saw strong tailwinds as well. From supply chain disruption due to over-dependence on China to fractured field work and numerous allied unfavorable changes, sector faced several challenges and has been able to overcome them. India slowed imports from China, resulting in a ripple effect on global trade flows. Most companies across the globe have been working to make their supply chains leaner. The outbreak of COVID-19 comes as a wake-up call for pharma companies to diversify their supply chains globally, geographically, and develop their local sourcing units and adopt alternative strategies for reducing dependency in a single supply source. For us, the consumer space has been a very critical part of our long-term growth direction. In FY21, we were able to continue to grow and add to significant wins there, leveraging our integrated solutions platform. Our focus on the segment has also helped drive accelerated growth for our freight forwarding services, which have grown at a strong clip in FY21. The last segment I would say talk about briefly is enterprise mobility. Our enterprise mobility segment continues to remain severely impacted due to companies following the work from home policy in the wake of COVID-19. During Q4, we have witnessed slight improvement in the segment. However, with the second wave of COVID-19, many states have imposed restrictions which have dampened the recovery move in the segment. Now, the government going into the third phase of vaccination, we believe that significant amount of our population will be vaccinated in the coming quarters. And post that, we expect improvements in the enterprise mobility market. The segment will also continue to see and shift towards electrification, driven by a stronger focus on sustainability and the comparatively attractive economics of electrification for large fleet operations. While the long-term dynamics of this segment still remain very attractive, and we remain strongly of the view that shared mobility market will bounce back, it will be critical for players to expand services and to innovate and launch differentiated offerings. At Mahindra Logistics this year, we have been trying to expand our shared mobility business to multiple new verticals such as manufacturing and e-commerce, and also have started the launch of on-call services and some B2B2C offerings to try and expand and drive service innovation. Now let me share the financial performance for the quarter ended March 31st, 2021. Revenue for Q4 increased to 974 crores from 812 crores for the same period last year, up by 20%, 96% of revenues, while enterprise mobility contributed to 4% of revenues for Q4 F21. Our gross margin 7% compared to 10.4% last year, and decrease of 61 basis points. As all of you have noticed, during the quarter we saw strong growth in the transportation business compared to last year when we had an impact of COVID affecting a lot of our transportation, especially in the second half of March. This year we saw a strong improvement in the transportation business with higher volumes, especially from the auto sector. And we also saw growth which was pretty strong in terms of our freight forwarding business. The increased weightage of our transportation business and the resultant mix impact it had was a large part of the impact on our margins on a blended basis. EBITDA for the quarter grew from 41 crores in Q4 FY20 to 51 crores in Q4 FY21, down 7% on a quarter-on-quarter basis. PBT was up 22% from 13.4 crores in Q4 FY20 to 16.4 crores in FY21, and PAT was up by 29% on a reported basis, to 12.5 crores in Q4 21. PAT margins on a reported basis for the quarter stood at 1.3%. It is important to note that during the quarter we recorded an exceptional item. We recognized an aggregate impairment loss of rupees 2.75 crores in our investment on account of our investment in our joint investment in Transtech Solutions, which is our software company which provides us ShipX, which is a transport management solution. As some of you may recall, earlier this year we had chosen to defer an additional investment round in the company, and in recognition of an updated view of the business, we had chosen to be prudent and write off the entire investment. That had an impact, an aggregate net impact of rupees 2.75 crores in the quarter. Adjusted for that one-time or exceptional impact, PAT was up by 47% on a year-on-year basis in Q4 F21. A proportion of revenue from the Mahindra Group comprised 51.5% in Q4 F21 compared to 50% in Q4 FY20. That was a reflection of our continued strength in the farm business, where the Mahindra and Mahindra farm sector is a large customer for us, as well as in the auto business where we saw the full impact of the quarter compared to the COVID impact last year. Let me also share segmental breakup of revenues for Q4 FY21. Revenues from supply chain increased from rupees 730 crores to rupees 938.4 crores. The enterprise mobility segment revenues stood at 35.7 crores for Q4 FY21 as compared to rupees 81.3 crores for the corresponding last year, a decline of 56%. The supply chain revenue demand in e-commerce and consumer verticals and the continued recovery in the on the automotive side and the farm side. Our revenue from the Mahindra Group supply chain business increased from 392 crores in FY20 to 500 crores in Q4 FY21, a growth of 27%. Our non-M&M SCM business, which is a key lever for from long-term value creation perspective, grew from rupees 337.9 crores in Q4 FY20 to 438 crores in Q4 FY21, registering a 30% year-on-year growth. This was due to continued increases in revenues from our e-commerce, consumer, pharma businesses, and a recovery in our automotive business, and a strong growth for our freight forwarding services. Our e-commerce, consumer, and pharma verticals grew year-on-year by upwards of 40%. Growth in e-commerce and consumer segments was due to increase in demand and deeper penetration with existing customers, while also providing more integrated solutions and services under the Mahindra Logistics umbrella. Our warehousing and value-added services for the non-M&M SCM business, which is a key part of our focus areas, has grown from 105 crores in Q4 FY20 to rupees 123 crores in Q4 FY21, registering a growth of 17%. While this was a slightly slower growth than previous quarters, it reflects a cyclical pattern to capacity addition. Some of our projects will actually be new expansions and new projects. Go lives will happen in Q1 of this year, and there's really reflected an overall adjustment in order timing. Our share of warehousing and value-added services in non-M&M SCM has reached 33% in FY21, up from 32% in FY20. FY21 stood at 251 crores. We remain focused on controlling costs and managing our cash flows into this period, which has resulted in improvement in our overall cash flows. The Board of Directors have recommended a final dividend of rupees 2.5 per equity share, subject to approval at the annual general meeting of the shareholders. Before I open up for comments, let me briefly cover our progress on our strategy execution. During the year, we remained focused on executing several of our key strategic platforms. Our first platform has been on expanding our new services portfolio. During the year, we launched EDEL and continue to accelerate our freight forwarding and express businesses. EDEL, which is our electric vehicle-based last mile delivery or last mile distribution service, now operates in 6 cities in India, and we look forward to expanding it to an aggregate of 20 cities. During the quarter, we also announced our partnership with Flipkart to accelerate deployment of electric vehicle-based last mile delivery in conjunction with them. Electrification of the logistics fleet is an important part of Flipkart's larger sustainability goal and is a key focus area for the company. We continue to see strong growth in our freight forwarding business segment and express B2B delivery businesses, which both grew by roughly 40% year-on-year on an annualized basis. The second focus area for us has been on growing our integrated logistics solutions portfolio. Our core focus as a company remains on providing customers integrated and customized solutions. During the last year, our solutions portfolio will continue to expand, and we were able to add new solution categories as well as grow our overall order intake on solutions. All of you have noticed that we also announced our integrated logistics services partnership with Bajaj Electricals, which involves complete end-to-end redesign and outsourcing of Bajaj's supply chain and logistics services, which will now be managed by Mahindra Logistics. This will also be accompanied by a transition towards sustainable logistics using last mile electric vehicle delivery, using our EDEL fleet. This broader solution portfolio approach is something which we increasingly see a high level of engagement from our clients. We added more than 1 million square feet of space, and close to 1 million in line with our guidance. And we continue to remain focused on adding 1.5 to 2 million square feet of warehousing space every year. Technology implementation is our third big strategic platform, and we remain engaged and focused on that during the year. Our technology stack, which has 3 layers, continue to see new enhancements and additions, and we have continued to expand and build on that through the year with several enhancements and additions to that stack. From a market perspective, obviously we remain focused on growing our fulfillment logistics business, which covers e-commerce, consumer, and pharma, and this is critical to our growth of our non-M&M pie. We continue to register strong growth in that space, as both on the back of market growth as well as our strategic focus. Let me, before I close up, also make a comment on the enterprise mobility business. As this segment continues to face headwinds, we have made an aggressive effort to add customer accounts from other industries. As I mentioned earlier, we believe the long-term dynamics of shared mobility, both from work from home and business travel, remain extremely positive. In the short term, we are focused on driving cost optimization and kind of driving and launching several new services to augment our portfolio there. And as I mentioned earlier, we are hopeful that over the next 2 to 3 quarters, we will start seeing a gradual recovery. Thank you all for your support during FY21. And as I said earlier, we are in an extremely challenging period right now with a lot of volatility, but the management team and the company remains committed to continue to execute our strategy and continue to drive strong growth, both in terms of revenue and earnings, right, over the near and medium term. With that, let me open up the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We would also request participants to limit your question to 2 at a time. Should you have a follow-up question, we would request you to rejoin the queue. Thank you. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mukesh Saraf from Spark Capital. Please go ahead.
Yes, sir. Good evening, and thank you for the opportunity. So my first question is, on the non-Mahindra warehousing piece, you did allude to some of the reasons there, but I just wanted some more clarification there. So, on a QOQ versus the December quarter, from about 160 crores, the revenues is now at 120 odd crores. So, could you give some more kind of clarification on this?
Yeah, so I think our warehousing solutions businesses, we obviously have, there is a seasonal trend line to that because we are delivering, volumes do vary while the facilities are operated at a certain level. We do have volume movement, and during the seasonal peaks or the high season periods, we obviously are shipping out more volume from those sites. So typically what you would see is that adjustment happens on a quarter-on-quarter basis. This year, in Q4, we did see a softer January peak. As you know, the Jan sales are a very significant, one of the big peaks for the year. And we did obviously see a softer peak than we expected. But essentially it was largely a seasonal trend line. We do not see any reduction in our warehousing space or drop in our business there. And as I said earlier, in my sense, we are in the process of launching several new sites, and those should kick in the coming quarters. Right? Obviously, with some of the increase in COVID cases, the launches have got a bit impacted, and so to see those start kicking up in the coming quarters. But that was the largest part of the change in quarter-on-quarter or sequential quarter revenues.
Sure. So on this itself, because you've been focusing a lot more on these flex solutions, which probably helped you in the previous quarter, do you think the seasonality will in fact kind of go up because of that? Vis-a-vis, say, the previous few years, this between 3Q and 4Q, does that increase the seasonality?
Well, I think obviously there is a seasonal impact always in our business, right? Because we are, as we get more into the fulfillment side of the industry, we will see the quarter-on-quarter movements. But if you combine this on but I think the underlying base is also continuing to grow. So if you mentioned, if you compare it on a quarter-on-quarter basis, year-on-year, you will see that we obviously saw 17% growth there, right?
Sure.
So the underlying base is also growing, but you will obviously see some level of seasonality on a sequential quarter basis when you compare peak quarters from a festive season perspective compared to non-peak quarters.
Sure. Understood. And again, on the numbers itself, in the P&L, other expenses seem to be much higher this quarter. I mean, usually you've been at that 17-18 crore run rate.
Yes.
This quarter is just about touching 24 crores. Is there any one-off or any reason why the spike we saw in this quarter?
Yeah, so I think it's a good point that you raised, and by and large, the largest part of it was some underlying categorized reclassification. But I will invite Yogesh to probably throw more light to your question. Yogesh, could you take this, please?
Sure, Ram. Hi, Mukesh. Mukesh, this other expenses, I mean, you've seen the classification of ours. Usually the transportation cost you've seen in the operating expense line item there. And the employee or people-related costs, which are directly, with people, comes under the people cost. And then the residuary cost is where the other expense line item usually is. I mean, the finance cost and depreciation amortization being specific to those type of treatment in the accounting mode itself. So this is, in cases where expenses where we have certain way of contracting would have changed in terms of manpower versus a switch or a toggle there. I mean, while you see the increase per se, you will also see a decrease in the other two costs, proportionately if you look at it that way.
Right. So it's just a recategorization.
It's a recategorization of expense, yes.
Right. And this is my last question. This is slightly more structural. Is that, I mean, we are hearing a lot about the newer e-commerce companies like Delivery and the likes of those, looking to pivot outside just e-commerce as their business, to B2B logistics and 3PL, etc. So we're hearing a lot more on their plans. So are you seeing some kind of increased competition on your B2B businesses, 3PL, be it express transportation or any of those businesses now?
I think competitive dynamic has always been strong in our sector, and I think by and large continues. I don't really think there's a dramatic shift because of this. I think what we mentioned even in earlier calls, we started, for example, in Q1 this year, we did say that I think we expect to see more service line integration. More companies investing, trying to bundle services together, right? And we also expect that more industry players will try to diversify markets. So just as we are trying to expand our fulfillment logistics portfolio and expand outside our the level while focused on our strength, we're trying to build new strengths in new markets. I would fully expect other industry players will also be doing that. And therefore, that said, I don't see a dramatic change in competitive intensity across the board. I think competitive intensity was always high. It remains strong. We obviously are in an inflationary environment with a lot of volatility on fuel prices. So I think cost is a challenging environment on cost. But I don't see a big change in competitive dynamic.
Thank you. I would request Mr. Saraf to rejoin the queue. We would also request participants to please submit your questions 2 at a time. The next question is from the line of Dipesh from Equirus. Please go ahead.
Yeah, hi, so thank you for taking my questions. So the warehousing space addition for the last 3-4 years has been in the range of 1 to 1.5 million square feet. And you have talked about the similar addition industry reports where we see that the warehousing grade A, B warehousing are going to double over the next few years, right? So are we underperforming the 3PL industry in this segment? Just your thoughts on that. And secondly, what kind of warehouse space additions do you plan for the Bajaj Electricals over the next 2-3 years? Thanks.
Yeah, so it's a good question. I think the way to look at this, the way I would see this is that when we look at the one, we kind of said we look at a bellwether addition of 1.5 to 2 million square feet a year. And that's kind of roughly what we will do on a consistent and continuing basis. Now, if you look at the market reports about how much of growth is there, a lot of that actually, and there is strong growth in the warehousing space, right? A lot of that also typically goes into non-fulfillment logistics spaces. A lot of it just goes into plain storage facilities. A lot of times those storage facilities are not necessarily logistic solutions which we participate in. So I think one has to be able to fragment that into multiple further pieces, and I think you will see the same reports, we can share some of those which we see with you. 3PL and 3PL companies have roughly been 40-45% of the capacity addition. So if you kind of break it down from there, I think you will find that our additions are definitely not below the industry run rate, right? So as I'm very confident about the fact that we are not really below industry run rate from our sector and services perspective. And I think what you will continue to see is that expansion. What we are also focusing on is to actually try and get to more complex solutions and from those facilities, and not just to storage-based services. Because storage-based services are really are a low value add play. What we want to do is more processing out of those facilities, which allows us to get more margin leverage, more stickiness, and more solution enablement to our customers. And as far as Bajaj Electric is concerned, which I think was part of your question, for BEL we are deploying a dynamic network. So it is not a static network. What we will be developing for them is a network of full houses, which are spread across the nation, which are interlinked, and then will be supported by two national warehouses or national distribution centers. Both the entire network largely will be built out over the next 12 months. And these include the two large central distribution locations are integrated with our build-to-suit network, and then the 11 locations are spread across all geographies. I would say that an approximation is roughly would probably be in the 2 million square feet range. I think somewhere over 24 months, as the network gets fully built out, we'll probably be adding 2 million square feet of warehousing to support the long-term fulfillment strategy there.
Understood, sir. Sir, the second question is, sir, how many electric vehicles related to EDU's business you have already purchased, and how many more are you planning to buy over the next 2-3 years, given the Flipkart and the Bajaj Electrical deal, please?
Yes, so obviously, first of all, EDEL is a last mile delivery service which is multi-customer. So obviously, while we've announced that we're doing Flipkart, we have announced a partnership, we are doing last mile delivery from multiple brands today. So we have maybe 10 or 12 logos of brands with whom we are providing last mile delivery services. We are right now at 6 cities, and we have procured a fleet of nearly 300 vehicles. Our long-term strategy remains a partnership model. So I don't see us necessarily adding a lot of company-owned fleet going forward. Really, it's about setting up the platform and driving platform operations in a way to drive the strong utilization and network management, which we are pretty much believe that we've got that model now sorted out and deployed in these 6 cities. So we will see some. So overall fleet will probably go north of 1,000 vehicles over the next 12 to 18 months, but a majority of those will increasingly not be company-owned assets.
Understood. Thank you, sir. Thank you, and all the best.
Thank you. The next question is from the line of Manish Goyal from Enam Holdings. Please go ahead.
Yeah, thank you so much, and very good evening, sir. Just to clarify on the earlier participant questions on the change in the cost on increasing other expense, and I see a significant decline in employee cost. So, can you clarify, is it pertaining to change in the contracts for both these items? Where it has got related question is that does any ESOP reversal have been factored in Q4 for employee cost to go down? And what was the full year ESOP cost?
So Manish, I hope you're doing well and safe, but I will, with your permission, I'll request Yogesh to address both those questions. Yogesh, could you please address both of them?
Manish, hi. So on your first question, yes. So the decrease what you see in employee costs, obviously, some part of it would be because of reclassification, but the quantum of it also has a linkage to a reduction in volume, which you saw from a warehousing business perspective, and hence people deployment becoming lesser from that perspective. So that would be a blend of both these reasons would be the delta.
Okay. And is there any provision of ESOP in this quarter, and what is the number for full year?
So answer for ESOP, when you say, Manish, we would have, I mean, there is reversal of ESOP cost, if any, would, I think in our current structure, would happen only if there is a people exit. I mean, if there is like a individual who would be a grantee, and if a person leaves the organization, then probably I would have to reverse the cost which we would have accounted for the shares which would not vest, or what the grants which will not vest.
Okay.
Other than that, there is no reason this year for any other reversal on ESOP cost. ESOP cost, which we would have taken for this year, would have been in the range of 8.5 crores.
Okay. Okay. And just one more question on the margins front. What I see is that we have a change in revenue mix. I am referring to quarter on quarter, that with warehousing revenues going down, but still your gross margins seem to be remaining steady. What I need to say is that transportation revenues going up and warehousing coming down. Typically, warehousing has a higher margin. But what we see, our gross margins percentage remaining steady when we look at the operating expense removed from the revenue. So just
So Manish, I think what we've seen obviously is within the transportation segment and many services we offer, and not all of them have the same margins profile. So what we have seen in the second half of this year, obviously, is stronger growth in our freight forwarding and distribution services, which tend to have higher margin within the transportation spectrum. And therefore, you will see that there has been therefore, on a quarter-on-quarter basis, it has been a more stable view. On a sequential quarter basis, it's been a more stable view. However, on a year-on-year basis, that growth in transportation, obviously, there's a fundamental, lower transportation margin on transportation. So on a year-on-year basis, the blended effect has resulted in decline. But on a sequential basis, some cost improvement work we have done, plus the faster growth in better margin kind of profile transportation service lines actually has helped maintain more or less steady gross margins.
Okay.
And
okay.
That.
Okay. And one last question on the just want to get a sense in terms of if you can share a number that with our non-M&M business growing and with new client addition, any perspective you can provide as to how is the revenue share growing from the new customer acquisition over a period of, say, last 1 or 2 years, or how do you see that momentum going? Because earlier you used to share top revenue share from the top 20 clients, but so just want to get a perspective as to how is it moving, sir, on the non-M&M customers.
Yeah, so I think our top, very simplistically, our top 20 customers are still around 60% of our revenue. Right. What is changing, of course, is that the names of the accounts are changing with more customers who are from e-commerce and consumer markets. Right. For us as a business, we have two sources of growth. We obviously have or three sources of growth. The first one is just existing customers giving us new areas of business. The second one is existing customers taking new solutions or services from us. And the third one is new customers. Obviously, for us, last year we have seen that there was a fairly strong growth in the new second half of 19-20 and the first half of 2021. Right, as we were trying to get the increased focus on the e-commerce and consumer and pharma spaces. The second half of the year, we've actually been trying to consolidate that growth and mine customers a lot more. So you will see the shifting pattern, but broadly, I would say that I think this quarter, my opening comments did not cover new additions. We had generally every quarter we do add that. And we are happy to respond to that offline, man. So if you can write to Yogesh or our investor team, we will respond and provide you more detail on that.
Wonderful. Thank you so much. Thank you.
Thank you. The next question is from the line of Ashwini Agarwal from Ashmore Investment Management. Please go ahead.
Hi Ram, hi Yogesh. Reasonable performance in a fairly difficult period. Just a couple of questions. Starting off with the first question on this Q&Q decline in the non-Mahindra and Mahindra SCM piece. We haven't seen that seasonality from 3Q to 4Q in the past quarter, specifically if I look back at financial year 2018 or financial year 2019. Of course, financial year 20 was slightly different because March was closed out. So has something fundamentally changed that we should expect this peak season because of e-commerce mix going up, or is there something else that we are missing?
So actually, if you look at Q3 versus Q4 FY20, I think you would have seen last year as well that the non-M&M SCM business declined from 393 crores to 338. This year it's declined from 501 to 438. So last year, if you actually look at the seasonal impact delta, I think in percentage terms it was probably sharper than this year. Last year was 15-16%, and this year it's on 14%. So all I'm trying to say is that it's not a fundamental. The fundamental shift is that 338 has gone up to 438. Right, on the non-M&M SCM side, right, so that growth is an underlying growth which remains stable. At year-on-year basis, I think you will see the seasonality impact has played out in the past as well.
I see that, Ram. My only, the question in my mind was that I was under the impression that fourth quarter fiscal 20, March, or at least 3 weeks in March, were very difficult. Starting, say, around the 15th of March, pretty much a lot of things went into a shutdown mode. And 24th onwards, we had a complete lockdown. So I was thinking that fourth quarter 2020 was, a number which was lower than what it would have been had the lockdown not happened. And so I didn't think about it as a seasonality. So that's why I was really confused.
Yeah. So actually, if you go back and look at our comments last year, I think you would see that we had reported a quantified impact of around 65 to 70 crores for COVID. Right? And there was split roughly 2/3, 1/3, 2/3 or 75% of that was on the supply chain side, and around 30% of those on the enterprise mobility side. And the supply chain side impact was largely on the M&M side of the business. Where obviously on the M&M auto side, a lot of vehicle dispatches got stranded or stopped. Farm sector continued last year as well because they were considered as essential services. So tractor shipments and movements do not get impacted. So that's why you are seeing an adjustment. Really on the non-M&M side, that was not a very, very big play because Janata lockdown was there, but then there was still, and with quarter last year as well, we saw a trading impact only pretty much at the end of the quarter on the non-M&M side. So I would just say that that's such a call out, and we can go back and I'm sure it's reflected somewhere in our earnings calls notes for those periods as well. And all I was going to say that there is a Q3 to Q4 seasonal impact generally on our consumer and fulfillment-based businesses because of seasonal impact. Whereas you see, even in the farm sector, you see a Q3 to Q4 impact generally because the second half of Q4 tends to be a bit softer unless there is stocking going on. It kind of stops around Pongal, right? That's an active window of demand in that window. So, but then in auto, usually seasons work a bit differently by segment, but on the non-M&M side, you will find this a very consistent trend. And I'm sure our team can help you look at more data, Ashwini, to kind of walk you through it.
Okay, thanks. No, that's helpful. Second thing is, could you provide some color on what you're seeing on the ground through April? I think May continues to be very difficult. We are hearing several auto companies taking shutdowns, maintenance shutdowns or, forced shutdowns. How are you seeing things pan out? On the other hand, other companies are saying that, look, transportation isn't really affected, so, things should be reasonably steady. What are you seeing?
Yeah, so I wish we could give you a perfectly clear answer, but let me break this into three parts. The first one is supply volatility, operations volatility, and demand volatility. So on the supply side, I think if you look at it, there is a lot of volatility in terms of just local operations of our customers, right? Different. If you look at the consumer e-commerce side, almost many locations have declared, shutdown of non-essential. There are some policy confusion. So I think you will find that the supply chains across for many industries are in a very volatile and fractious position, which obviously makes it very difficult for us from an operational stability and cost perspective. So it is very volatile out there, and I think it remains a large challenge. From an operations volatility perspective, I would break it into two parts. I think in our facilities, we are seeing a lot of disruption, a sharp increase in pandemic and COVID cases, and a lot of our employees who are seeing the risk actually even from a work from home perspective. So that is creating a lot of operational inconsistency. There is some migration of labor which has started. There is higher challenges of absenteeism in different geographies. So warehousing operations are seeing a lot of day-to-day volatility. On the transportation side, I think we have still not seen on the line haul very significant impact because lockdowns are not national and the lockdowns have not happened across the board everywhere. And therefore, the vehicles are still on road. Even if you look at Maharashtra, I think manufacturing companies have largely been under classification. So in that sense, I think we have not seen, till we start seeing 7-8 states actually going into lockdown together, right? And we start seeing widespread detention, there will still not be a huge disruption. It has started adding, I think detentions, etc., have been going up, but still in a manageable window as things stand today. Demand volatility is which is very hard to predict right now. I think given some of this is regulatory, saying non-essential cannot move, cannot be fulfilled in some channels, we are seeing a lot of movement in demand. And some categories which are discretionary categories like apparel or mobile phones, etc., we have seen sharp dips in those categories in terms of movement of what we are moving on the ground of those categories. Some like pharma, of course, still remain pretty stable or even growing. So it's a mixed bag, but I think demand will take some weeks for it to get a little bit more clearer. But volatility on the ground is there, right? Though less in transportation on line haul, that's why. I hope that helps, Ashwini.
Yes, this color really helps. Thank you so much. All the best, for the future. And
Thank you. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Hi Ram, hi Yogesh, and thanks for the last answer. And just continuing with the same, and I think you alluded on this earlier as well in one of the questions. The newer client ramp up that we have been adding over the last couple of quarters. And now, given this disruption overall, do you believe or are you seeing there is some pushback of some demand from these guys with whom maybe we are already started doing some business, or maybe we were about to start and may get pushed back by a couple of months or quarters?
So, Ankur, I don't think there is a pushback. Obviously, some of the new accounts have added, and within that, so we've got a range of solutions now. Some of those are long-term solutions. Some of those are also things like pop-up and flex solutions. And I think disruptions are unfavorable to some and favorable to others, right? So, there are situations where customers are taking a pause because of this, but what it also translates in flex or pop-ups and so on. So it's a mixed bag really, Ankur, on balance. right? On the orders we've already booked, we don't see any kind of relook or change in them. There might be some execution delays because of the high level of exposure which are there right now and our own safety protocol. We are slowing down some construction because if we see high impact areas from a pandemic perspective. But fundamentally, I think that's an issue of weeks, Ankur, and not months. Okay. So all the businesses we have ramped up on and the account additions we have got, we think that there will be there's some delay probably, but not, it will not slip by quarters, for example. Right? New account addition, yes, some of that is always gets slowed down in an environment like this. Because as I said earlier on, Ankur, demand variability still is something which exists. And every time you have a situation like this and sentiment is a problem, you will obviously see some impact of this, and that color change slows down some decision making with our clients for sure.
Sure. That's helpful. And second question there, one on our capex plan going ahead. Will it be a similar run rate that we have seen last year? And just one clarity on the subsidiaries margin. We are seeing slight decline, and I'm looking at more of the full financial year, FY21 over 20. The subsidiaries margins look like a decline. Is it more because of the subdued Q1 or something more to read into it?
Okay, let me just answer the subsidies and then I'll ask Yogesh to add to that and also address the capex, Ankur. So I think obviously you're right. So some part, I think one secular impact on all the subsidies, both Lodge and 2x2 has been Q1. Take that out, I think we have different things playing out in both the subsidiaries. Obviously, on the 2x2 side, which is a joint venture we have, the challenge there has been just the broader challenges which have been in the auto sector as a whole, where detentions continue to be a significant challenge for several periods, for a majority of the balance 9 months as well, barring 2-3 months. And that has impacted us. We also chose not to choose moratorium, etc., and continue to make out all the payouts, right? Because we thought that was more effective from a long-term perspective. So that impacted 2x2. On Lodge, I think what you've seen is very, very strong growth has partially been through our efforts to expand markets and so on. But to some extent, has also been because of an underlying inflation in rates across the board, Ankur. And therefore, what happens is, given, and I mentioned this probably last quarter, that we continue to see significant volatility in international freight lanes. And what that has meant, obviously, is an increase in the underlying cost basis for the industry. So if you are making, let's say, if it was costing you 100 rupees last year today it's costing you 120, right, or 115, right? Now 10 rupees on 100 is 10%, but 10 rupees on 110 is 9%. Right, you're still making that 10 rupee margin, but you obviously have, or slightly more than that, because you're kind of paying working capital cycle and so on. But your customers do put you under pressure because it's a cost basis inflation as well. And that's the big play which you're seeing on the Lodge side. Right? Overall, I think our freight forwarding business had a really strong year, by the way. A 45% growth despite the impact of the pandemic on a full year basis with some strong margin expansion. And we are optimistic. As you know, we expanded our equity position in Lodge last year, Ankur, and we are optimistic about the runway that business has.
Great. That's helpful. Just on that capex question.
Yeah, Yogesh, you want to take the capex?
Yes, Ankur. So Ankur, comment on subsidiary margin was also on margin percentage, right? Because absolute terms, obviously, it's increased.
That's right. I was referring percentage only, which I'm clarifying. Yeah.
Correct. So, on the capex part, next year's plan is what you look for. So I think given the warehouse space management increase is in that uniform range, I think we would have our capex outlay also between 70 to 90 crores for this new fiscal year.
Okay, that's helpful. And congratulations on healthy working capital management. Should we expect this trend to continue going ahead, or there could be some one-offs here?
No. So working capital management can't be one-off. What would be one-off? I mean, you are aware, Ankur, historically that we had these income taxes, refund stuff which we were collecting, and on that pieces, I think this year again, we managed a good recovery out of that. So those, I mean, in theory becomes one time, because once you collect, there is, but there is the integral part of working capital management also has been our improvement in our DSO days. And I mean, honestly, I mean, with the improvement in DSO days, we have also managed to reduce our DPO days to an extent as well. So that kind of goes towards more healthier business, practices per se. But this improvement in DSO days, what has been driven, obviously has to, I mean, the improvement drive itself has to sustain, and hence sustaining the new numbers definitely is integral.
Great. That's encouraging. Sorry, yeah.
Because I just asked that obviously cash to EBITDA yields are very critical in terms of management focus. So while the absolute levers may change a little bit based on things like what we can get on tax, refunds, and so on, in terms of management focus, I think we articulated 18 months ago that that's an important area where we are focusing on, and that will continue to be there, I think on an enduring basis.
Sure, Ram. That's helpful, and all the best. Thanks.
Thank you. The next question is from the line of Shyam Sundar Sriram from Sundaram Mutual Fund. Please go ahead.
Yeah, hi sir. Good afternoon. This is Shyam from Sundaram. Thank you very much for taking the question. So my first question is just some broad, if you can share some thoughts on how much capex would be this Bajaj Electricals deal, which is a 1,000 crore order, and on the Flipkart deal as well, which you had announced for the last mile delivery. Just some understanding will help in will help a long way. And an added part of that, typically for a warehousing value added solution contract, what is the minimum threshold ROC that we target per se? That is the part of the question.
So Shyam, you asked 3 questions in one question, but I hope you're doing well, firstly, and safe. So let me answer the last one first. I think in terms of return capital employed, we have capital return targets which are driven by service type and solution offering, which are then indexed for 2 things: market segments which we operate in and the strategic nature of the account. And therefore, there is no one bellwether number. Obviously, they are all aggressive. So we have some very aggressive return expectations on the solutions and the warehousing-based businesses in line with that. But they differ by, for example, and let me do why, and just add why I'm not giving you a specific number, because, for example, if we do a solution which is a pop-up or a flex for 6 months, the way we have priced that in terms of return expectations can be very different from what you do as a 5-year transaction. Okay, right, on a 5-year contract, because your cost stability, your return invest risk profile is all different in each of them. But there is a heuristic or a pedagogical structure to driving that, and the net on a risk-adjusted basis is securely ensured to be attractive. As far as the capital requirement for Bajaj is concerned, I think the number which Yogesh laid out for capital just now in the question Ankur asked just before Shyam, and I assume you heard that capital outlay pretty much includes our outlay for all our accounts, including Bajaj. As I mentioned earlier to one of the questions which was asked on the Bajaj project, the large central distribution centers are actually co-located within our BTSs. So we are not making those contractual positions based only on a full consumption of that space by BEL, right? And therefore, it's a multi-user facility in which BEL will be one account. The aggregate capital of that is what Yogesh has outlined in his comments a few minutes ago. On the EDEL side, which I think was your other question, I think I addressed it earlier as well, saying that we have now bought close to 300 vehicles, or 30% of the fleet we have targeted for the first 18 months. So we launched the service. We had said within a 12 to 18 month window, we want to build around 1,000 vehicles. We are roughly around 30% of that. And on an incremental basis, a lot of those assets will actually be partner supplied fleet. It will not essentially be necessary fleet which will acquire ourselves. And therefore, I expect that the vehicle or the fleet addition capital for that will continue to tail off, Shyam. okay, and will not be a very significant part. But that's kind of the broad contours of the spend. I don't know, Yogesh, if you want to add anything which I have not covered, but I hope that answered your question, Shyam. Yogesh, anything you want to add? We'll look back, Yogesh.
Sure.
And get back.
Sure, sir. Just one question on the financial assets in the consolidated balance sheet, which is around 354 crores. I think from the annual report, I saw this annotation of accrued sales percentage has been increasing over the last 3 years. Just trying to understand what is this line item, if you can throw some light on that. And secondly, on the payable side, the payables has actually increased at the end of the year. Is there any change in the terms of trade? Thank you.
Good. So let me, Yogesh, are you there? Can you?
Yeah, I'm here. Are you able to hear me?
Yeah. Now you're good.
We can hear.
Okay. So on the accrued sales piece, Shyam, the way our business gets conducted, usually the performance of the business is done in a particular month, and the invoicing is done in arrears, in the sense once the performance for that period is over. So usually you will see the services which you have delivered in the immediate month would have yet to be billed out and would stay as a accrued income. This amount would have increased because our business itself has grown year on year.
Okay. And once it is invoiced, it will become receivable. That is how.
So yes, it goes into.
Okay. And on the payables, sir, any change in terms of trade? I'll stop here. Thank you.
So payables is also linked to, that's pretty direct, right? In terms of, 100% asset-light business. So most of my direct cost, other than, your own people, comes as payables. And that's again in relation to the business volume itself.
Okay, because the full year revenues was actually declined year on year. So I was just wondering why your payables at the end of the year are higher. Okay, fair enough, sir. Thank you.
Thank you. The next question is from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yes, thanks for taking my call, and I hope everyone is keeping safe in these times. My question is regarding the warehousing business revenues again. I think a lot of participants have asked this question, but the thing which is surprising is that by the time 9 months revenue came out, we were actually looking to significantly improve on the yields of the warehousing business. When I say yield, I mean warehousing revenues per square feet per month. But with the Q4 revenues out, it seems to be, which is a bit surprising because we have been reducing on the stores line fees as well as the stockyard space. And the value addition is also, at least on a perception basis, was improving. So if you can just, sort of throw some light on it, because there's almost 1.5 million square feet addition during the course of the year. So does this mean there's significant underutilization and you will move up meaningfully next year, or does this mean, the competitive pressures have sort of flattened it on a YY basis? How to look at it?
No, Abhijit, great question, and first, I hope you are safe as well. So I think there are multiple things which probably have to get peeled out a little bit. So first, I think if you look at it from, let's just first address the capacity addition issue, right? So you are right. As you see, we added 16.5 going up to 16.2 going to around 17.7 million square feet. I think if you look at a lot of these additions, every time you add warehousing, you don't go to peak revenue on day one. Okay? So when you add a facility, it actually takes a month or so for it to actually blend into 1% quarter for it to actually get fully up to a peak. So when you are seeing a point of time, Abhijit, on March 31st, we said 17.7 million square feet. You take that and divide the revenue by that. I think you are, it's sketched to be a slightly funny number. I think if you actually look at the average of 4 quarters, I think that would be more representative of the actual space which was realized and used. Okay. The same thing I think is true also, Abhijit, for the revenue side. And if you take Q2, Q3, Q4 cumulatively and you divide it what would be by our average square feet, and then you compare it to previous year, I think you might see a slightly different trend line. And the reason why that becomes relevant is because of two things. One, we are doing things like flex solutions. So we do have seasonal solutions also which come in and go out, Abhijit. The second thing why it becomes relevant is because of the fact that, the underlying seasonality in the business results obviously in the same warehouse having a different level of utilization during peaks versus during Q4. If February and March, if the e-com volumes are down or your consumer volumes for a certain kind of food category are down, you obviously would see that at a certain level of utilization, which is, let's say, at 100 units. Now, during Q3, that the same facility might be churning out 200 units, right? So if you take a point of time and kind of take that as a factor and compute it, I think you will find a very different pattern. So it's important, I think, to not look at this sequentially, to look at it year on year, right, and say, okay, what was it from a year on year perspective or from a full year average basis. Now we can share that with you, Abhijit, and I think you will find that the trends are favorable and I think are consistent with the perceptual view, right, and we'll be happy to do that offline with you.
Sure. I'll take that and I'll sort of rework the numbers. But in terms of guidance or target, do you sort of target an yield improvement, or it's like, of course, it's a combination of contract, but
I think I mentioned this earlier as well, that clearly I think from our perspective, we are trying to do lesser storage-based warehousing solutions or warehousing services to providing more processing-based solutions from our warehousing facilities.
Right.
So if you look at it in Q2 and Q3 on a year-on-year basis, our warehousing space did not go up so much, but our revenue did go up. Right? Faster than probably our space did. So this is a little bit of a point of time perspective, but our underlying trend is very much as you do more of these solutions, I think you will see generally that improvement on yield levels because we are doing more complex work. Now, you must factor in, however, that we are also building out larger facilities. This year we built several large BTSs. Many of our facilities now are on average 350,000-400,000 square feet. So the facility comes in at a point of time and takes a month or two to get fully filled up, right? And therefore, while we declare that the space is live, or because we are implementing projects in that space, it doesn't mean that it's already translated into real. There will be some delta in that, but otherwise the underlying premise is one of enrichment. Right? And we don't give guidance in that, but that would be the expectation on which we are deploying our strategy.
Right, Ram, and if I may come in here, Abhijit, what Ram's also not saying is absolutely right. If you were to measure us on a very short window, this aberrations would come, and hence, like we had done in the previous years also, for these yields, you should rather look at it on a YTD basis for us. And then that would be a proper reflection of the change in business volume versus yields.
And also on an enrichment basis, if you look at delta of revenue on warehousing versus delta of space, Abhijit, I think you will see that there is a different curve which is visible there. But as I said, I think our team can work with you offline to clarify this further.
Thank you. I would request Mr. Mitra to rejoin the queue. The next question is from the line of Manish Bhandari from Vallum Capital. Please go ahead.
Hi, good evening, Yogesh and Ram. My first question is regarding the cost savings for Bajaj Electrical in terms of your engagement in next 5 years.
Yes.
Hello, can you hear me?
Yeah, I can hear you. I couldn't hear the question. I know you.
Yeah, so my question is, what is the cost saving for Bajaj Electricals in the next 5 years by moving the whole logistic arrangements to you?
Yes, I think I would defer to I won't speak on behalf of Bajaj, but I think I would defer to Anuj's statement which he made when he and I spoke to CNBC together. But I think he quoted that they expect a 25% reduction from a cost perspective. I have since clarified there since then that the way the contract is structured is as an output basis. So you have to look at cost both in terms of dollars spent, but also in terms of the volume which is spent for those dollars. But that is the guidance which they shared with CNBC, I think, and otherwise when they made the press release. You may want to see.
So what kind of investment you need to do in this deal?
What kind of investment?
You need to do in this deal. I mean to say that Mahindra Logistics need to do.
Yeah. So I think as I said, we build out infrastructure which requires really 2 million square feet of warehousing space from a mid-cycle perspective, Rish. So I think that is contracted warehousing. A large part of that is in multi-user facilities. Right. Apart from that, there will be investment in terms of racks, sortation systems, warehouse storage systems, and so on, which are intrinsic to our solutions designed for them. The last mile delivery, which is done on electric or through our EDL service, is a shared service. So it basically leverages a pool fleet which we are creating and not a dedicated investment for Bajaj. Those are the big specific elements which are there. I don't really have a number to call out right now, but if you want, we can get you a more specific answer.
My second question is regarding this 10,000 crore vision statement you have. We have moved from 5,000 crore vision statement now to 10,000. So what is the missing piece, what you think you need to bolt on to make this reality or maybe closer to the reality?
Yeah, so I think we've commented on this a couple of times earlier in earlier calls as well. So obviously, I think we revisited our vision statement. It was 6,000 crores earlier, not 5,000. It was 6,000. We upped it to 10,000 by FY 25-26. And I think there are four underlying elements in that, which is kind of four big elements there. Some of them are firm specific and some of them are broader elements. So let me just talk about them in 30 seconds quickly. The first one obviously is we just see an increased formalization right across the logistics industry given more favorable policy. And that is an important element which we think will drive the adoption of 3PLs. I think we're seeing that more actively over the last 12 to 18 months, right? And that kind of help the industry get back to a low to mid-teens kind of growth level, which we've been talking about for some time. So that's one. The second thing which we are from in 2019-20 perspective, when we made the vision, was that we expected a correction in the automotive industry. 2019-20 was a very significant downward correction, and we expect a reset and normative growth in the industry. The third part of our growth hypothesis, and you have seen this as I commented earlier on as well, our express business and our freight forwarding business. So we've launched several new services or expanded them, EDL, express, freight forwarding. Right? These are the service lines that we were historically underrepresented in. Right? And we believe that there's an opportunity in those last mile delivery, freight forwarding, express to significantly expand our share of business there. That hypothesis, that is a strategy which is working out. We've seen 40% plus growth on those service lines annualized despite the pandemic impact. So we expect that we can maintain that kind of strong growth there. And the fourth one is our ability to create integrated solutions. So combination of these, we think, between faster growth in some service lines, right, a firm-specific focus on solutions and integration, with some macro moves around sector changes in auto and just broader economic revival, I guess, are the four big elements of that 26-27% CAGR of growth we'll have to deliver to hit that 10,000 crores. Now bear in mind the 10,000 crore number is a vision, it's not a guidance. And I just want to caveat that.
No, I appreciate that. I have a suggestion. Your opening comments were worth close to 25 minutes from 4 o'clock to 4:26, and many of them were already, you have repeated this in the presentation. So if you can limit the opening comments to 5 or 10 minutes, we'll have more time for the question and answer and again insight from your commentary.
I'd love to do that as well. So I will definitely try and take that opportunity.
Sure. Yeah. Thank you. Thanks a lot.
Thank you. We'll take one last question from the line of Mayur Pakeria from Wealth Managers. Please go ahead.
Good evening, and thank you, Team Ram and Yogesh, for taking my questions. Decent performance in times like this. I had two questions. One on this again, the vision which we have set out. Does this, while you have laid down the elements which needs to be, which you will be focusing on to deliver this kind of thing, does it also involve further addition of verticals apart from our current verticals? And if you can throw some light from that side towards your long-term goals.
No, to be honest, I don't think we will be adding more verticals. I think we may be adding more service lines. So our verticals are really get organized right now by market and service lines. So the markets are pretty broad-based right now. I mean, we got e-commerce, all our consumer markets bucketed together as a consumer vertical, and then we have our automotive and engineering, kind of verticals, which covers automotive and manufacturing. So I think those broad verticals remain the same. Those are our focus markets in addition to enterprise mobility, right? So within those, we'll obviously continue to deepen the business as we kind of keep growing. But where I think we'll see more expansion is the front service line. So I talked about this earlier as well, that we have been focused on accelerating freight forwarding, right, and EDEL and Express. So that kind of service and expansion will continue to happen as we try to build a bouquet of different services and integrate them for our customers.
When we see any 3PL player globally as well as in our domestic industry also, some of the players which are there, a strong anchor client has been a backbone of the ability to provide a large, ability to provide a successful 3PL services. Even in your case, auto was an M&M being an anchor client and M&M and auto being an anchor sector. We were able to, penetrate the sector, understand the sector, the domain expertise came, right? I was happy to hear Flipkart deal on that side, but it was more on the EDEL side and electric vehicle side. But where are we in terms of having customer contracts from an anchor perspective in e-commerce, pharma and consumer? And if you can throw some qualitative light and, maybe even some number of clients, and when do we think we'll be able to get on, some of them? Because that is something which will be most important to understand the domain when you say service line expansions and all. They will help us, leverage that. So some comments there, and how do you see that?
So it's a great question, and I think obviously it's good to have anchor clients because they shape the way we drive scalability in any end market, and I'm glad you asked the question. We don't design ourselves like service line. Yeah. So as I said, I think it's a great question, and if you look across our markets, on the automotive side, we have 3-4 anchor clients. We have obviously Mahindra and Mahindra on the auto side, but we also have a very large commercial vehicle player. We have a couple of other logos in the luxury car space. So I think by market, by vertical, we have some pretty strong players there. If I look at the e-commerce space, while I don't want to name them, I think we have very deep partnerships with the large marketplaces in the space. Right. And similarly now, if you look at the consumer pharma space, we have been adding anchor clients in each of them. Bajaj itself is an example where Bajaj on durables, we've been adding anchor clients in each of them. So when I say that our top 20 clients are right now 60% of our volume, that's because those top 20 in many ways actually reflect the anchor positions in each of those end markets. And I mentioned this earlier on, that while top 20 are still 60% of our revenue, the profile of those 20 has changed. It has moved from being 20, let's say, heavily weighted in one segment, towards being 20 now becoming more widely as anchor clients in different end markets. So we have now durables. We are the same in pharma. We are the 2-3 big clients or anchor clients in consumer. And our relationships there are not just based on needle. They are pretty much widespread, right? So we have that now fairly covered. But we don't, as a policy, name our clients without client agreement because we design customized solutions for each of our clients. But we have deep anchor positions now in most of our verticals.
Oh, okay. Can I just take one short-term question, please? This is a very near-term question, so I just...
Go ahead.
Thank you. Does the current COVID-related vaccination logistics issue the cost, is it since the vaccine itself is priced quite low, does it create any stress on the financials for FY22? I understand from a moral side this is good, but just from a, will that FY22 bake in some of those numbers in a little lower margin side, or how is it for us?
Affecting us from a vaccination perspective, very honestly, I think we've modeled that out, and we at MLL we've already announced that we will provide vaccination for all our employees and their spouses. Right? We might expand it to their families as well, but we will provide free of cost for all of them. That's something which we're confident as an organization we will do the productivity improvements to offset that cost.
No, in terms of the business of supply logistics, that is not what we are in.
Yeah, I think the business side of pandemic itself, I mean, there's been a lot of noise around this, a lot of visibility around it. But if you really look at it right now, every vaccine which is being made is just being possibly moved as soon as possible to the localist nearest point of demand. We have said earlier on that there are 3-4 buckets of demand: warehousing and storage, delivery and distribution, freight forwarding and international movement, and last mile delivery. Today, given the pandemic which we are in, there is not too much of storage. All the vaccines are being made are pretty much going to be shipped across to last mile delivery locations, for consumption, right? And there is no freight forwarding or international movement of drugs which are very permitted at large scale. So at this stage, I don't think it's consistent with the view which you shared earlier that the COVID-19 vaccines are more of a medium-term business opportunity rather than a short-term business opportunity. I'll kind of close my comments there on that.
Okay. Thank you, and wish you all the best.
All right. Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the conference over to the management for closing comments.
All right. So thank you, everyone. I hope we've been able to answer all your questions satisfactorily. However, should we need any further clarifications or would like to know more about the company, please feel free to contact our investor relations team or SGA, who are our investor relations advisors. Once again, I want to thank you all for your support and engagement in what has been a very challenging year. But a year where we've continued to try and expand our strategic focus and make the moves to continue to strengthen the business from a medium and long-term perspective. Thank you all once again for taking the time to join the call, and we wish you all health and safety in this very challenging environment. Thank you.
On behalf of Mahindra Logistics Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.